Hello friends, welcome to our special edition of the Market Views video. In this video we interact with Alok Agarwal, who is a fund manager with Alchemy Capital, and Mr. Hiren Ved, who is a director and CIO at Alchemy Capital. Your host today is me. I am Himani Shah, an SVP in Investment and Research here at Alchemy. So Hiren, I'll start with my questions, first question with you. And I'll start with the most pressing questions that most investors have, which is markets have had a good run and earnings so far have kept a pace with the valuations. But going forward, what is your view on the Indian market valuations?
So first of all, thanks Himani for having me, and hope our investors like this format. To answer your question, yes, I think with the run-up that we've seen in the markets over the last couple of months, there is a feeling, predominant feeling amongst investors that market valuations have really run up. India is very expensive. But if you look at objectively at the data, right, I mean the Nifty today is trading at about 17.5 times 1 year forward earnings, which is exactly in line with the 10-year average, right? Now we use these historical benchmarks as more as an indicator, right, how overvalued or undervalued you are. But really the question we should ask is that, are we better off today than we were 10 years back? And clearly and unequivocally the answer is yes. So in fact, one could argue that if the macro is better today than what it was 10 years back, if bank balance sheets are better today than what they were 10 years back, if the corporate sector is deleveraged today more than at any point in time in the last decade, few decades, then the market should actually be trading at a higher multiple than the 10-year average, right? Also, in the last 10 years or, pre-COVID, if I were to say, earnings growth was more in mid-single digits. Today, in the post-COVID, we've seen earnings growth in healthy double digits. And if you look at the next 2 years consensus earnings growth, for the Nifty at least, that's hovering in the range of 14-15%. And the broader markets or the companies in the top 500 in India have also delivered upwards of 15% compounding returns, in fact more like 20% compounding returns. So I think the macro is in our favor, and so is also the micro and the earnings picture. So I don't think that markets are anywhere overvalued given this context. Coming to small and mid caps, which have run up slightly ahead in the last few months. But if you look at a slightly longer term context, right, if you look at where the markets were in October 21, which is when last time the broader markets peaked, valuations for Nifty, small and mid caps are at a discount to where they were in October. So we've spent more than 2 years going nowhere, right? But because we tend to look at markets from the lows of March, it kind of seems like the markets have run up quite a bit. However, I must say that having said that, does this mean that markets won't correct or can't consolidate? No, markets could correct, could consolidate. We have to be mindful of a few things that are happening in the environment right now. For example, oil prices are almost touching $100. And US yields have also kind of hardened. So it's quite possible that after a very good run, you could have a phase where the markets could go sideways or even correct. But at a more structural, fundamental level, I do not think that the markets are overvalued.
Thank you, Hiren, for the answer. Alok, that brings me to my second question, which is if you see domestics are most invested in the small and mid caps, do you think the valuations there have run ahead of themselves?
Thanks for having me, Himani. And your question has about 3 parts. First part being on the rally in the small and mid caps. In FY24 so far, while Nifty is up about 14%, the mid and small caps are up anywhere between 36 to 40%. And that's where the whole market is wondering whether enough has been done on the broader markets. Hiren already explained that from FY21 peaks, the numbers don't look that big. Even if you go back since the last major rally in small and mid caps in 2017, since then, while Nifty index and the mid cap index are up around 105%, the small cap index is up only 49%. So there's a fair bit of catch-up potential still there. So it's not overstretched so far. The second being on the flows. Yes, the domestics are more invested into the small and mid caps, while FI portfolios are more tilted towards the larger caps. If we see last 3 to 4 years number since the end of 2019, the FIs have put in about $25 billion and they control about 40% of the free float. But the MFs have seen an inflow of close to $55 billion. So there's a large part of domestic money that's actually coming into the markets. But on the valuations, if you look at the numbers objectively, the Nifty Midcap Index is trading at around 23 times on 1 year forward. This is about 13% premium to its 10-year average valuations, but it is 30% below the peak seen 2 years ago. In small caps, the index is trading at 16 times on 1 year forward basis, which is actually in line with 5-year average valuations, and also 30% below the peak seen 2 years ago. So while the rhetoric is that the valuations have got stretched, the fact is the returns have come on the back of strong earnings. And hence to that extent, I do think that while the markets aren't exactly cheap, but they aren't overstretched also.
Thank you, Alok, for your answer. That's very insightful. Having said that, the markets don't look overstretched and it's kind of backed by earnings. Hiren, you've been in the market for the past 30 years. Which sectors do you think can lead us into the future?
Yeah, I know I get this question quite often. What sectors should we look at, right? I think there are opportunities across the spectrum, right? But there is an old saying in the markets ki naye race ka naya ghoda, right? Every bull market has new leadership. And typically what we've seen from experience of cycles is that every 8-10 years there is a change in leadership. I think if we look at this bull market, if we can call one from the lows of COVID to where we are today, I would say that we see clear tailwinds in manufacturing as a big theme, right? Now manufacturing is a very large theme, there are a lot of elements in that. But if you look at the previous big bull market that India had between 2003 and 2008, the sectors that were leading at that time, which is capital goods, infrastructure, real estate, autos, auto ancillaries, cement, all cyclical and capex driven sectors, I think their time has come back. They didn't do anything post the global financial crisis right up until COVID. But now in this cycle, I think all these sectors will come back, right? So we think that the infrastructure, capital goods, auto ancillaries, cement, real estate, which participated in the previous cycle will also participate in this cycle, and a couple of new sectors will get added to that. Because the economy is changing, new opportunities are coming up. And if I were to name 3 or 4 of those, one is electronic manufacturing services, right? With the whole Make in India, focus on not importing and making a lot of the stuff in India. Defense, very similar. We've been importing most of our defense requirements. Now there is a very clear policy focus to get more manufactured within India. Electronic vehicles, right? We are seeing a massive transition in transportation. So that entire value chain of EV, whether it is batteries, whether it is the end OEM players or, somewhere in between, there will be a lot of plays that will feed into the EV trend and the value chain. And last is the whole energy transition, right? Moving away from traditional power to renewable energy, which will also create opportunities in many small mid-cap companies, though you have some big large conglomerates trying to take advantage of the energy transition, but down the line there will be lot of subcomponents of the renewable energy chain where a lot of small mid companies will also take part in that. So I think manufacturing as a theme clearly to me is a theme for the next 10 years in India. Having said that, on the consumption side, I think that this time the focus has to move from staples to discretionary, right? As India's per capita moves from $2,500 towards $5,000, that incremental delta is largely going to be spent on discretionary. So sectors or companies where there is a large scope for premiumization are the sectors where we think growth will be very strong. So whether it is in beverages or alcoholic or non-alcoholic beverages, whether it is in food, whether tourism, luxury retailing, I mean these, and there can be many, QSR. I think that discretionary consumption should do extremely well over the next 10 years. Coming to tech, and I think we've said this several times over also in our monthly videos, is that we believe that we see a big opportunity in the ER&D space within the bigger tech landscape, right? And these are companies which are likely to grow faster than your large cap tech companies. And we have a lot of investments in that area in our portfolios, and we still continue to be bullish. I also believe that if you look back and see, every time there is an emergence of a new technology, it creates the next wave of tech spending, right? So when cloud came, there was big opportunities for Indian IT services. Before that it was database, before that it was ERP, and the Indian tech services industry has captured every tech cycle. I think the next tech cycle is also very interesting, and which is on AI and digital, right? Especially AI, given the fact that some of the large global tech companies have doubled down on AI spending. I think most corporates around the world will think about, how do I use this AI in my business to improve my productivity or to enhance my business? And I believe there will be a new tech spending cycle that will come up, which will also benefit the IT services companies in India, but we'll have to pick and choose there. So I think if you look at manufacturing, discretionary consumption, tech, that leaves you with pharma and chemicals. Again, traditionally a core strength of India. But here again, we've kind of moved away from the usual generic pharma kind of stories to contract research and contract manufacturers, right? I think there will be greater intensity because of China plus one, that more and more research and manufacturing will shift to India. And again here, we have made a few investments, and in the future, I think we will continue to concentrate on that part of the pharma and the chemical value chain. But as I said right up in the beginning, that doesn't mean that we don't look at other sectors. Financials is a large part of the index. We will continue to look for opportunities where companies are growing. Digital will play a very big role in financials going forward, so we will look at that. Then there is the whole new internet sector, but there you have to be very picky and choosy. Hopefully now valuations are far more reasonable from where they were in 21. There was a lot of euphoria back then. Again, there will be some opportunities that we will see, but I think this is where we will focus going forward as well.
Thank you for that. So we are seeing structural changes happening in India. We've seen the PSU bank index also participate. It's up almost 40% since March this year. Would we be looking to investing in PSUs in the future, Alok?
Himani, investing in PSUs, let me put it this way. For us, what's important is sticking to our mandate and our investment style. What we do is we look for companies with higher certainty of higher growth, good quality, and valuations which are not too overstretched. For a variety of reasons, over the last decade or so, PSUs did not give that visibility or the certainty of growth. Now the things are changing, and when things are changing, we also need to change in the changing times. Some of the sectors that we are more bullish on, Hiren also said that on the manufacturing side, some of the things are coming back. Sectors like defense, railways, power, and even the corporate lenders who would be lending towards the capex cycle as well. A lot of beneficiaries of these sectors are actually in the PSUs. So when they are likely to benefit, their certainty of growth goes up, we are likely to pick them up. To highlight that, one of the top 3 stocks in our high growth strategy is a PSU name. In our Smart Alpha 250 strategy, around 25% of the strategy is invested in PSUs. In our assets portfolio, it's about 32% of the portfolio. Having said that, and as you mentioned, there has been a significant rally in the PSUs, including PSU banks in the last 1 year or so. Till now, Nifty PSE index is trading at little over 9 times on 1 year forward, which is in line with the 10 years averages. So we do see an opportunity of higher growth, certainty of it, and valuations which are not stretched.
Hiren, does this mean that when we see changes in the market, like the elections or the budget, do we change our market positioning based on our near-term market views?
So, Himani, good question. Yes and no, right? And I'll explain why I say this. See, there are certain events which come every few years. We know them. You mentioned elections. We have elections every 5 years, but we have state elections almost every year. We have the budget every year. And I know there is a lot of chatter and hyperactivity during these events, and people try to correlate what will happen in these events to what can happen to the market. Frankly, I think our experience has been that you cannot predict with great certainty some of the outcomes. And what you can't predict, there is no point responding to that by changing your portfolios, right? So no, the answer is that will we change our portfolio because there is an election in 2024? The answer is no. I may have a personal view, or people may have a personal view of what may or may not happen in the elections, but I think we are all running long-term investment portfolios based on a certain hypothesis, right? It's an event for which you can't say with great certainty what the outcome could be, and therefore we will not respond by making changes to that. But as active investment managers, we always have to look for what's happening in the environment, right? Where we will respond is, for example, if we think that there is a big regulatory change which either enables or hinders a particular sector or investment idea, or if we believe that the competitive intensity in that industry is changing, which may mean that none of the players might make money for a couple of years, or even if they do make money, the market may discount, may reduce the discounting of those companies in a hyper competitive sector, and you may see a derating for a while, right? So if there are structural factors that we believe impact the long-term earning capacity of a business, then I think it is important for us to respond. But we do not generally tend to respond to events, and especially events where you do not know with great certainty how they will play out, right? And we've seen this across the board. Even in 2004, there was a change in government, and it was not as per the expectations of the market. The market did correct sharply, but I think within a quarter it was back up. In 2009, for example, nobody expected any party to get a majority, but you had a different outcome, and the Nifty was up 20% the next day the markets opened. How could you plan for something like this? You can't, right? So I guess sometimes markets will react either positively or negatively, but those reactions generally tend to peter out over a period of time, and then people go back to focusing on fundamentals of businesses. So I think that's how we will deal with these situations as they unfold over the next few months in India.
Thank you. One of the risks that probably comes to my mind is oil, which is basically up 20% since March. Alok, what impact could that have on our markets?
Interestingly, crude is one variable which can impact macro numbers to a large extent. In India, most of the variables are within the control zone or the comfort zone. Our recovery from the COVID has been excellent. Our fiscal deficit is on a consolidation path. Our current account deficits as well as BOPs are improving. But the issue is crude, wherein nearly 80% of our requirement is imported. And hence what happens to the global price has an impact on our imported price as well. A rising crude has an impact on inflation. It does impact our trade balance, current account deficit, and an otherwise resilient rupee could also become volatile. That's the impact that crude can have. Now the dilemma with the government is whether to pass it on or not. If they pass it on, it impacts inflation immediately and hence it impacts the fiscal later on. If they don't pass it on, it impacts fiscal immediately. And this dilemma becomes even more heightened given that we are into an election year. Having said that, crude is roughly, as mentioned, rallied significantly, close to $98 now, more than 10-month highs. Sustainability apart, we have seen that there is a supply cut by the OPEC, as well as we are seeing the fall in inventories by the largest consumer, that is US. If crude were to go beyond $100 or possibly settle there, that is bound to have an impact on our macro expectations and hence an impact on our equity markets and flows. So that's a variable to watch out for. And yes, India would celebrate in case that number were to come down.
With that, we come to an end to our market views video this month. We hope you find it interesting and we look forward to any feedback from your end. Thank you and stay tuned while we stay invested in you.